This conference will now be recorded.
Okay, hello everyone. My name is Daniel. You're listening to and watching Infravest. Just wanted to basically cover over a comment. So we had a question in the previous video. If you haven't taken a look at this video, I go over what is liability-driven investment and talk about UK pension funds and how this LDI strategy spurred up this margin call kind of scenario, which could lead to some sort of issues down the road. So take a look at that video. It's on the channel there. And so I made a remake of it just to explain better about LDIs. So in that remake video, we had a comment, a question. This comes from Prashant. And this basically, the question here says that can you also make a video on Italian and Germany bond spread and in general Italian debt issue? So sure, I will do my best to explain the situation and I hope this helps. So for anyone, if this helps you, please feel free to subscribe, hit the bell icon, like and comment below. And if you also have a particular question that you want to go over or something that you want me to cover, please feel free to comment in the comment section and I'm more than happy to cover any of the topics that or questions that you may have. So let's begin. So let me start off by talking about the Italian debt issue. So in Italy, when we hear about everything from let's actually start back in 2012 to bring it back to bring it into today's context. So since 2012 and during 2012, Mario Draghi, who was the um, head of the European Central Bank, basically came out and said a statement that he would do anything he'll do whatever it takes to save the euro. And that was during a time when a lot of these weaker countries within the European Union was going through a lot of trouble. And to name some, Greece, Portugal, Spain, and so on. And there were a lot of issues that were happening in terms of the debt levels and in terms of these economies, which caused Mario Draghi to come in and make that statement, saying that he would do anything and he's ready and willing to do anything to save the euro, and which involved basically buying a lot of bonds, printing a lot of euros, and adding basically the debt level. Now, fast forward when we look at the the Italian economy, right? Italy's economy. Um, we see that the debt level has exacerbated to basically 2.5 trillion euros. So it's quite, and you can't really ignore when something is in the trillions, especially when it comes to an economy that is on the verge of basically breaking. Now, funny to say that Mario Draghi was the head of the ECB back then, and then eventually when he left, he went on to pursue and be the president of Italy. Now, and now fast forward after some time, he has resigned that role, and now there are bunch of there's now votes going on to figure out who's going to be the next president in Italy. So right now, over the 10 years, there's been quite a mess of this buildup of debt to then this kind of government issue that's happening within Italy, and trying to figure out in terms of politics who's going to fix the mess of all the problems that Italy is facing. Now, I want to share with you a very interesting chart here, and I'll share my screen. Just give me a second. So when we look at the top countries in terms of nominal GDP, Number one being Germany, number two, the UK, number three, France, and number four, Italy. So definitely we can't ignore Italy because number one, it's the top four producing country when it comes to GDP, and number two, it's got $2.5 trillion in terms of debt. So if something's going to break in Italy, if something's going to happen, if the debt levels are becoming too much for the country to handle, especially when we have higher interest rates, it's definitely a very big problem if you've got $2.5 trillion that are just going to pop all of a sudden, right? So why is this a problem now and why not? Why wasn't this a problem 1 or 2 or 3 years ago? Well, if you remember past 2 years ago, we had the 2 years ago we had the COVID scenario, which brought in more money, more stimulus, more printing, and more buying of bonds, which basically flowed into a lot of these economies and very ultra low rates, which a lot of these economies and a lot of these countries were prospering from. But now with all this that's happened, plus COVID, plus the supply chain issue, we had inflation rise, which means that how central banks around the world, including the ECB, are trying to combat inflation with raising rates aggressively at a very, very fast pace, right? When you look at the Federal Reserve, when you look at the ECB, when you look at Bank of Canada and so on, Bank of England, they're all raising rates to levels and the speed and the velocity of how they're raising rates is just very dangerous when you have debt levels of 2.5 trillion, let's say in Italy, or you have high debt levels in countries where the GDP to or the debt to GDP ratio is 150% or more, or 200% or more, 300% more. It becomes very painful to make your debt payments on a high amount. Now, you may be thinking that, okay, yeah, interest rates have been rising, and it's at levels that we've previously experienced in the past. It's not like interest rates have gone from 0 to 10%, or 18% like back in the 80s and so on. We're still at a single digit area, and it's still not bad, right? Yes, that's true. However, back in the 80s versus now, we're dealing with a very, very different situation where we're dealing with more debt. And guess what? In the future, we're going to deal with more debt again, and more debt is going to be added as as the next cycle comes in, and it's just a simple cycle that happens over and over again, where basically you have the markets tightening, interest rates going up, balance sheet runoff, followed by a recession, and then you have to cut rates again and pump more money, do your bond buying purchasing program to stimulate the markets all over again. And that's what the markets are anticipating and betting that, again, referring back to what Draghi said long ago, that they would do anything. He's willing and ready. The ECB is willing and ready to do anything to save the euro. That's what a lot of market participants are now pricing in, that the same scenario back in 2012 to save a lot of these weaker economies, weaker countries within the European Union, we're going to see again with Italy. Now, um, again, Italy being fourth on the GDP list, Italy seeing that its high debt levels can definitely spark something in the whole European Union. It can definitely be a trickle effect among all the countries within the European Union. So definitely this is something to keep an eye on, especially as all of these European nations are facing problems with inflation, higher rates, more pain when it comes to their payments on their debt levels, consumers finding issues with, employers finding issues to basically hire people, and there's not enough workers, and they're trying to incentivize workers by increasing the wages, and also consumers feeling the pinch with the higher food prices, right? Especially in Italy and all other countries as well. And energy prices, let's not forget about that, with Putin closing the taps with the gasoline, the natural gas, and pushing prices higher there, which could mean that this winter could be very, very rough for Europe. So the whole problem with Italy is the debt, is the interest rate, is the level of high inflation. And you're basically in a scenario where you're now cornered. You're cornered because you have 2.5 trillion in debt, and you have to make higher payments on it, and you have high inflation, and you have your consumers who are feeling the pinch, businesses that are feeling the pinch, and definitely if they can't find enough workers and there's not enough demands, definitely you will see those businesses shut down, and that economy, something again probably will break and burst, which will then seep in and trickle into all the other European economies. So that's the number one thing. Hope that answers your question about the Italian debt issue. Now, going to your other question about the yields, right, between the Italian and the German yields and that spread. So let's take a look here. This is the Italian 10-year yield. We see that the Italian 10-year yield just basically has been skyrocketing from lows of, let's say, 0.5% to all the way to highs of almost close to 5%. And now, if we compare this, let's do a comparison with Germany's 10-year yields. You can see that the 10-year yield in Germany also went up quite a bit, but peaked around 1.9 to 2%. Now, don't forget, Germany is the spine. It's the spine of Europe. It's the country that will take Europe out of or hopefully take Europe out of a recession. It's the one that's going. It's the powerhouse that's going to help Europe when it comes to their growth and economy and driving good economic prosperity in the future. So that's how Germany is looked at, right? Now, when you look at the yields, and remember, yields on a bond is considered, and every yield is different because it has many factors and calculations that go into the calculation of a yield of a bond. And the yield is basically the return that you're going to receive. So if a bond, or if a debt level, right, is considered or deemed to be risky, you're going to ask for more higher return, higher yield. For example, if I were to give a loan to you, and I looked at your credit history, and I see that you've had a lot of defaults, you had a lot of bad payments in terms of making your in time monthly payments, and you asked for money. Am I going to offer you a interest rate that is low, or am I going to offer you an interest rate that is high? I'm most likely going to offer you an interest rate that is high because you're a risk. So if you're a risk and I'm going to take a risk on you, a chance on you, I need a higher return. So same thing in this scenario here, we see the government bonds 10-year around 1.9, and the Italian bonds around 4.2. So that spread, that difference continues to widen because there's more risk when it comes to the Italian economy versus Germany's, because of the amount of debt level that's just piling up, because of the amount of consumers that are feeling the pinch, the fact that their government, the president, resigned, and they have the whole basically political issue there. And on top of that, let's add even more pain with Putin shutting down the natural gas to Europe, and winter is probably going to end up looking very, very ugly for a lot of these countries. And that being also countries like Italy versus Germany. Germany is much more of a stronger economy than Italy. Italy's going to feel the pinch a lot. And on top of that, the history of the debt levels that have increased back in 2012 till now, that's been added on. And now when you're in a high interest rate environment in today's terms, right? Not in 1980s, I understand. Back then it was much, much higher. But in today's terms, with the amount of debt that you have, 2.5 trillion is not something that you can ignore. So that's why the spread between the Italian bond yield curve versus the German yield is widening and widening and widening because of that risk. Now, if I look at if I just take that spread and I just measure it here, Italian 10-year minus the Germany 10-year here, this is what the spread looks like. Let me just take this out here. So here's the spread. So when this spread goes up, basically you're seeing that we're getting a widening that's happening here. When it comes down, then you've got the shrinking of the spread. And notice one thing on the spread. Notice how it has been going up, and it's been widening, and it's been widening at a very fast pace. Notice how this happened also during COVID pandemic, when that crash happened back in 2020 in January, where the spread also widened here. The spread also widened here in 2018. And hey, remember 2012, which I talked about, where a lot of economies were facing problems, and Draghi had to come out and say, they'll do anything to save the euro. Guess what? The spread also widened. So the spread is a not bad indicator to look at when risk is increasing between the Italian yield versus the German yield, right? So if you take that spread, every time it widens and goes up like that, we see risk. And then when it comes down, that's probably where you'll see the stimulus coming in, where the ECB is coming in to protect the economy, where the ECB is coming in to protect the countries in Europe. And that's where, the cut of interest rates come in, and more money printing, more euros into the system to the save the countries, which also means the debt level just keeps piling up and up and up, and that's the reverse. So that's the spread between the two. Now, if you want to look at the yield curve individually of the Italian yield curve and the Germany yield curve, right? We'll just look at Italian real quick, 30-year yield curve minus the Italian 5-year. Here in this scenario as well, look at this. Now the yield curve on the 30 to 5-year has also been coming down. It's basically flattening and almost close to inversion, but not exactly. Now here in 2020, we inverted here. Uh, and here in this year of September, we got close to it, we did not invert completely. And the reason behind that is because you do have the ECB coming in and softening the yields in Italy, right? ECB is now, although ECB is increasing interest rates and doing tightening, but guess what? They are favoring Italy because of the situation they're in right now, because of the government issue that they have. They don't have a president. So the ECB decided to come in, and because of one, yes, the president, number two, most importantly, their yields, the Italian yields been skyrocketing. Let's look at just the Italian yields one more time. So the 10-year just skyrocketing. When the yields increase, This creates pain for businesses and consumers. This creates pain because if 10-year yields rises, then it means more payments. Interest payments are higher when it comes to businesses that need to pay off certain loans, right? Same thing with consumers and so on. So if this continues, if this yield continues, it's a problem for Italy, and that debt bubble can definitely burst and will trickle into all other countries. Now, that's why the ECB is coming in and saying, okay, we're going to start buying the Italian bonds to bring down those yields to soften it. So that's why you see it kind of coming off a bit, and that's why you could argue that maybe that's why it didn't invert completely, because you've got the ECB from behind doing a very specific strategy to attack the Italian bonds and buying them to bring those yields down to soften the pain a little bit, right? How long will this last? Will it work? We'll see, but definitely it hasn't dropped, the yields haven't dropped substantially. The spread that's widening between the Italian and German bonds, still there's a big gap, and still there's a lot of red signals and signs for Italy and for its markets, especially if yields continue to be elevated, and if they continue to rise, then that's pain. That's a lot of pain for consumers and businesses to come. Now, last but not least, I would like to also show you the German 30-year against the spread, 30-year minus the German 5-year yield curve. And very interesting here. Remember, like I said, Germany is the neck, the spine, the one that's there to support the European economy. Now notice this, the 30 to 5-year yield curve inverted for the very first time into deep, deep, deep inverted levels, very negative inverted levels. So what does that mean? That means that generally, if you look back in history in 2007, we did invert a little bit, but not exactly. Back in 2000, the dot-com crash, we didn't invert it at all. We just flattened. So generally, this curve doesn't invert so much, or even if it flattens it, yes, we did invert in 2008, but it doesn't invert deeply. But we have a scenario here where the European spine, the main country, has inverted into deep levels, and that shows signs of distress. And what this yield curve basically means is that when you start to price in that the 5-year German government bond is costing you more than the 30-year, that's a problem, because you're saying there's more risk to come now versus 30 years down the road. So I hope this video helps. Hope this summarizes basically the yield curve of Germany, of Italy as well, the spread between Italy and Germany, Italy's history, European history, and the debt levels and the problem in today's market, right? Yes, rates are moving up. Yes, they're not at levels back in 1980s, but it's a problem because today's not 1980. We have a very, very big debt bubble that cannot handle very high rates. And if this continues and the yields continue, then definitely there can be something that could break, right? We don't know what exactly. I don't know what exactly. I cannot predict anything, but I can tell you that these are some of the red signs, red signals, and this is what I see. So anyways, I hope this helped. If you feel that it helped you, please leave a comment below, subscribe again, give a like, share this with your family, friends, and I hope to see you in the next video. Cheers. Bye.